And that's working. Okay, so welcome everybody to this webinar on the freezing of the lifetime allowance and how it could affect you. We've got two speakers today, Graham Laverick, who many of you know is Managing Director at Prismatic Wealth, and we're also joined by Andrew Derrington from PUMA Investments, who will take on the second half of the presentation. If I haven't already mentioned, could you just pop your microphones on mute just so that we don't have any background noise when the presenters are speaking. We'll have some time for questions at the end, but if you have any questions that you think of throughout the presentations, you can certainly pop them in the chat box at the top, and we can address them again at the end. But if you think of them as you go through the presentation, just pop them in there. Just before we start, just a little bit of a disclaimer, I suppose, that all of this presentation is based on our understanding of current taxation law, HMRC practice, and that all of your individual circumstances are different and could be subject to change in the future. So just our disclaimer there. Okay, so I'll pass you straight on to Graham, who will give us a brief overview of the lifetime allowance.
Thanks for that, Vix. Hopefully this short presentation that I'm going to do won't be like an episode of Line of Duty that some of you might have been seeing recently with so many abbreviations in it, but it's a pretty technical sort of subject. Been doing a bit of research over the last few days and how time flies. Pension tax simplification was a policy, would you believe, that was announced by the Labour government in 2004 to rationalise the British tax system as applied to pension schemes. It came into effect, would you believe, from what we call A-Day on the 6th of April 2006. And at that point in time, I won't do this as a quiz question, but the lifetime allowance, would you believe, was 1.5 million. It did rise to a peak in 2011 of 1.8 million. And here we are today with the number. And again, governments don't make it easy. You know, why we've got £100 in there and it couldn't be rounded to a set number, who knows? They do say it was at one point in time it was linked to the rate of inflation. So it was 8 different pension tax regimes we streamlined into one. And would you also believe that the annual allowance, i.e. the amount of money that people could make as a pension contribution at that time, was the eye-watering number of 215,000. So, you know, here we have a situation where it's dropped all the way down to £40,000, but again with some other caveats in terms of depending on what your earnings are. So for someone who's earning, you know, over £312,000, you actually got an annual allowance of £4,000. So there's various things in terms of lifetime allowance, annual allowance, money purchase limits. So as I say, here the abbreviations all start. So it's a complete mixed bag. The irony of pension simplification is we have a system that is ridiculously complex, more than what it was before. And you could say that it's a penal testing on contributions going in, and then again when benefits are coming out. So I'll let you all judge if this is fair. And I think I know what the answer. Is. So here we are today with the figure just over you know, £1 million, and it is affecting a lot of people. So next slide, Vix. It's frozen until 2026, and again there's some interesting stats that are coming out from this, and this is just an article from it was taken from either the Sunday or the Saturday Times, and an expectation by some firm of actuaries that we could have 1.25 million people going over the lifetime allowance over the next 5 to 6 years. when they retire. So the tax charge, when it was at 1.8 million, would you believe, was only 37 million, and here we are, going up now to 4,500 people affected in 2017 to 185 million. So again, it's a nice little earner from any governments in terms of how the number of people is affected, and there's a lot of issues that we need to grapple around that. So I'm not going to give everybody all the solutions today. Time doesn't permit it. So it is really just a very, very quick whistle tour. And Andrew will also mention a few ideas that he has about how you can work within the lifetime allowance as it currently stands. So next slide, Vix, please. This is an interesting slide, and I've had discussions with a number of people over the last few months, and equally the rest of the team has, and people say, oh, I'm not going to be affected by this, and it may be that you think that you've got a pension fund that is relatively too small, but depending on what your growth assumptions that you make, and some people might have property within the pension, some might have fixed investments, but it's a little bit of an eye opener in terms of, depending on what level of return you're getting on your pension fund, how you can be affected. So someone who's got a pension pot of £700,000, and we're looking at a growth assumption there of 5%, you're going to hit it within about 8 years. If it's slightly higher return, and as I say, you might have property in there, you're getting rental income and so on and so forth, the numbers jump down quite dramatically. But that just gives you an illustration as to how many people might be affected. And bearing in mind that this allowance has been frozen until 2026, there's a number of people who could be affected over and above the 1.25 million that has been predicted by a firm of actuaries. So this is a bit of a bitty slide. I just wanted people to be aware that there are various protections, and that some people in this presentation might be looking and put their hands up and say, well, I'm not affected by the lifetime allowance at just over $1 million. I have got protection. The protection, though, does not help anybody who's been making pension contributions over recent years. So anyone in the fortunate position that they had a pension fund over the dizzy heights of £1 million 5-10 years or so ago could have done some element of protection, but there is an extreme limited window for people in the current regime in terms of how they can protect their pension pot against the lifetime allowance charge. So as I say, that's a little bit of a bitty slide, and I don't intend to go through all of the various columns, but protection does exist for some people, if they are fortunate by that. Unfortunately, people who are making existing contributions are unlikely to have any protection against their pension fund. So the current lifetime allowance is well and truly going to be just over the £1 million mark. Next slide, please. So without protection and still paying into a pension, what choices do you have? Well, you can obviously stop your contributions for those people who are still in work. And that might be an attempt to keep you within the lifetime allowance. I was talking to someone last week, and they said, well, if I stop my pension contributions, it doesn't affect the rest of my benefits, i.e. my employer won't continue making a contribution. They won't pay me that reduced or stopping of the contribution in terms of my salary, so I'm just as well just to continue. So again, you can continue paying contributions. I would also say, think very carefully where you are getting an employer contribution. And most people, if they're in a senior category of work, are likely to be getting a higher contribution. So the lifetime allowance isn't a hard limit, but it doesn't stop you making further contributions. The charge does apply when you hit the does not hit when you just hit the lifetime allowance. So again, that's a little bit of a misnomer that a lot of people think as soon as you've hit that there is a charge, but it does start to take effect as and when you take the benefits. And there is an example coming up where I'll try and guide you through a very, very simplistic sort of approach. So how is the tax charge calculated? And one of the things is that we have, again, two basic pension regimes: a defined benefits and a defined contribution. Defined benefits are also commonly known as final salaries, and people say, well, I'm only getting a pension of X £1,000 a year. How does that go against my lifetime allowance? So you multiply that figure by 20. In addition, you add on to that the amount of any tax-free cash that you've been taken, and you can exclude your state pension. So they're not taken part, in the calculations, but that will have a figure that goes against your lifetime allowance. If you're in a defined contribution scheme, it is basically the value of what it is worth, i.e., the fund value. I know some people on this call also have property. So if you were actually taking benefits at that particular point in time, it would be the value of that particular property that would be tested against. You couldn't use a valuation on a property, for example, that was 3 or 4 years out of date. So there's only a tax charge when benefits taken, which are covered by the remaining lifetime allowance, and I'll explain that in a little bit more detail with a couple of the working examples. And we have different names for these, which is called uncrystallised, crystallised, a benefit crystallisation event. Again, back to the old abbreviation. Uncrystallised is basically someone's pension pot before they've actually taken any of the benefits. Crystallised is actually when you've taken part or the whole of those benefits. And a benefit crystallisation event is when you've actually taken the benefits. The lifetime allowance charge, if you do go above all of that, there are two charges in terms of how it is actually paid. 55% taken if it's taken as a lump sum, and 25% taken as income. The rationale from HMRC on that point is pretty much to do with the fact that they do not want to see that anyone has a tax advantage of taking it either way, so that you could be in a better position than someone else. So the only other point that we often get asked about is, how do I actually pay that tax charge, and if and when it is relevant. And in the majority cases, it's not a case of you writing out a cheque to HMRC. It's taken out of the scheme. So some people will see, certainly on a defined benefits, that the benefits are just reduced. So instead of you getting a pension of £50,000, for example, it may only be a pension of 49,000 because it's been paid for by the scheme. So the various potential strategies that people can actually look towards doing: you can crystallise all the benefits immediately or only in part, and there are advantages of doing it either way. Quite often we will say to people that if you don't need it, don't take it. So what is the point of taking benefits from a tax regime that is quite favourable if you then go and put it back into your own personal sort of investment, that the tax treatment might be slightly not to your benefit. So again, we can't be specific in terms of this particular webinar that it's an all fit for everyone. It's a case of looking at your individual circumstances. You can delay all your benefits. So What's the point of that? Well, who knows where lifetime allowance may well be. Could it be higher? Could it be scrapped even? When is the last test? It's at 75. You can take excess benefits as a lump sum or as an income, as I mentioned just previously. You've got the estate plan bit as well to consider, in terms of taking money out of your pension pot. It then goes back into your estate. How worried are you about such things as inheritance tax, for example? Or you're not bothered about that you've taken out one area and immediately you could have a tax liability of 40% on that. And there is a little thing called the small pots. In terms of the overall numbers, we're playing with pocket money here, but you can take £10,000 up to 3 times as a small pot that does not affect your lifetime allowance issue. Great, and a lot of people be saying, why can't we actually do that? Not all providers offer that facility, so it all depends on where your pensions actually are in terms of whether you can facilitate the small pots rule, but it is there. So let's have a look at a couple of examples here. So I've used an example here of someone with a £1.4 million in their pension pot, and again, part crystallisation there, so that they are taking, so that is that's 25% is tax-free cash, which is the first figure on the left-hand side at age 65, and basically that can be actually all taken, tax-free. Do what you like with it, but again, bearing in mind that one of the points that I would always make is, well, if you're taking all of that, what are you going to do with it? And think of the taxation implications of it, investing that. Yes, you can make ISA contributions with part of that money, but it's only at £20,000 a year, per person. But also bearing in mind that anything that you have actually taken out of that particular tax-free cash, if it's gone into ISAs, is then subject to potentially inheritance tax, although the fund will actually go tax-free. Then you've got your 804. If you add those two figures together, you come up to your current lifetime allowance, and then you've obviously got the excess there. We then got a situation there that the excess figure of £326,000 would then be tested again age 75, and then we've assumed there that there is a growth rate of 5% on that pot that gets you to the 532,000. So then you've got the final test at age 75. The death benefit situation is there's no test, and the full drawdown pot would be available for death benefits, but the test which is on the uncrystallised fund is automatic at age 75. So that's part crystallisation. The other alternative is a full crystallisation, and again, bearing in mind that these are just two examples, and the only purpose of this in terms of today's webinar is to make it one or the other. There's a lot of other alternatives in between, but it would just overcomplicate it if we shown too many figures. So this is a scenario where someone would say, I just want to do it all at outset, Graham. So again, the same sort of scenario with the figure, first of all, which is your 25% of your current lifetime allowance. The remainder that then is in drawdown. So therefore you've exceeded, and some of you will see this actually on statements that you might get from different providers as to how much of your lifetime allowance you've used. So in this particular case, it's 130%. The remainder is then taken in either the form of income, or it's taken, as a lump sum. And then the test again is on age 75 on the funds over and above the 804,000 or the 1,050,000 as the case may be. and then the excess is charged at 25%. So on death before age 75, there's no test, and the full drawdown available is available for for death benefits. We haven't touched, and again, this is really has nothing to do with lifetime allowance because it affects everybody, but the death benefit situation is also an important consideration in the fact that if someone was to die before age 75, the full value of the pension pot up to the lifetime allowance would be paid, totally tax-free. So that's a very, very quick whistle tour in terms of the of two simple case studies based on 1.4 million. The maths and the principle of all of this, is exactly the same. So the dilemma really that faces everybody on this call is that if you're in that situation, if you don't need the money, what the heck do you actually do? And it is a little bit of a dilemma. You can redirect pension contributions, and if you are over 55, you can draw an income from your pension and pay the income tax on it. Redirect that income into an ISA, which grows tax-free. You have got such other things like, we call it a single premium investment bond or an offshore bond that can grow, and you can put basically trusts and so on and so forth around all of that to give you an element of protection. And there are some more boutique sort of investments that allows you to get some taxation advantages. And I really want to just end my little bit there and introduce, or let Vix introduce you now to Andrew, who's going to talk to you about some of the other alternatives. But this is not an answer to everyone's situation, because you are all individual. You'll all have different needs. You'll all have different expectations, and you'll all have a variety of different investments relating to either defined benefits, defined contribution schemes, a combination of the two. More importantly, where your investments are currently held and what options that gives you. You're pretty restricted to some extent if you're in a defined benefit scheme and you can't move some of those benefits out, or you have got significant amounts of money in properties and you don't particularly want to sell those. So on the basis that you're getting a reasonable amount of rental income coming in, but there are solutions. And thank you for listening. You probably have questions that you want to put, and I'm more than happy to try and answer those at the end. But I'll hand over to you, Vix, to introduce Andrew.
Thank you. Thanks very much, Andrew. I should just be able to stop my screen and you should be able to share yours now. Perfect. Yeah.
How's that, Vic? Is it okay?
Yep, we can see that. Thank you. We can hear
Lovely.
you. Perfect.
Wonderful.
Thanks,
Right.
Andrew.
I will start. Thanks ever so much, guys. Thank you ever so much for coming along, and obviously to Graham and Vicky for inviting me to do this. I'm sat in the middle of Scotland. Believe it or not, I look after all of our advisors in Scotland, Northern Ireland, and down in the north of England, and hence looking after Graham at Prismatic and the team there. My background, guys, is maybe different to a lot of people who do this sort of job, but I'm an accountant and sort of tax advisor, albeit a long time ago myself, but been in the tax efficient world. So you're looking at investments that also give you various tax breaks for some 16 years now. Known Graham for a wee while, and we've done business with Graham has done business with us, so he's obviously comfortable with PUMA and hopefully me. So really what we're doing today is looking at, as we say, sort of alternatives to pension contributions. Graham has very helpfully gone through the issues with the lifetime allowance. So really today I'm going to focus on one really potential solution as to what else you could do as an alternative to a pension. I'm going to touch on one other actually, which does a similar sort of thing, but we'll cover that off. But anyway, guys, that's where I'm coming from. I'm very aware you spend a lot of time on screens at the moment, so I'm going to keep the slides as short as possible and hopefully talk around them. So PUMA Alpha VCT, let's come back to square one and think, well, what is a venture capital trust, which is what VCT stands for. Essentially, all a venture capital trust is a company. It's nothing more than that, and think of it as a big box. And when you buy shares in that big box, essentially your money comes in to the VCT and is then acquires a portfolio of stocks or shares, if you like, in smaller companies. And we'll look at the size of these companies as time goes on. So that's really all it is. You're buying shares in a company and then having exposure to lots of other companies. Okay, and the government brought the tax relief rules in for VCTs in 1994, quite some time ago, to encourage you to invest in smaller companies. And we'll link all the tax relief back to why to the lifetime allowance issue that Graham's talked about. So let's look at the tax reliefs that a venture capital trust would afford you. Well, when you buy shares, if you put £100 in this venture capital trust, the big box that I mentioned, then if you put £100, the government will pay you back up to £30, and that is income tax that you have suffered in the year in which you invest in the VCT. So right here, right now, we're obviously in 21-22. So if you put money into a VCT, then the government is going to pay you back up to 30%, so long as you've suffered, in that example, £30 of income tax. If you've only suffered £20, they'll only pay you £20 back, but they'll pay you up to £30. So if you think about it, when you're putting money into a VCT, you're investing £100, and that £100 is being deployed over a number of companies, but it's really costing you 70. Okay, but your return is clearly being based on 100. So, and it's a tax credit. We don't have to worry about what rates of tax you pay and actually what income it is. So as you can imagine, going back to what Graham was saying about trying to limit the amount that you might want to put into a pension because you're hitting those lifetime allowances, this is really, well, what else can I do that gives me some tax relief, because I don't want to put any more into a pension. And this is where the boom really, certainly since the limits that Graham mentioned came in 3 or 4 or 5 years ago, has really led to a big increase in the demand for VCTs. And to put that into perspective, the average investment into something like into VCTs is actually £20,000. Okay, so roughly that sort of amount. So very, very sort of small numbers really. And the 30% income tax credit, I think the important thing is that that applies to absolutely any income. So some of you may well be remunerated by way of salaries and bonuses. Fine, it can mop up that tax. A lot of you may well be owner managers and take money out of your company both as a salary and as a dividend. Now, when you take out as dividend, you can't reduce the tax on that by making a pension contribution, but you can with a VCT. Okay, applies to anything that sort of is deemed to be income tax. You can offset using a VCT, so we can get the tax back on a dividend. So if you take a dividend out of the company and pay tax on it, some of that dividend you can put into a VCT and effectively reduce the rate of tax that you're suffering on extracting the money out of the VCT. Of course, the money isn't yours, it's now in this VCT, and we'll talk about what it does when it's in there. Other income, Graham touched on it earlier on, rental income. You may well own properties and earn rental income. You might own those properties actually in a company, so the rental income you earn, is held within a company. But when you take that out as a company, clearly you're taking it as a dividend. If you own the properties yourself personally, then clearly that rental income is going to be taxable. And whatever the tax is, we can mop it up with a VCT. Okay, another one might be a surrender of a bond. Some of you may well have bonds. If you encash a bond at a gain, it gives rise actually to an income tax charge, not a capital gain. And you could mop that up with a VCT. So essentially what you
Andrew, you've gone on.
Andrew, you've gone on mute.
Still on mute.
That looks like it, Andrew.
Sorry, guys, I don't know what happened there. Is that better?
Vicky's got a power cut, so I don't know if it's something to do with that.
I didn't touch a bean, but never mind. These things happen. Okay, guys. So let's crisis averted. Really, the thing to do is to perhaps look at last year's tax return. Think about what was my income tax liability last year. Let's just call it £20,000. Well, I could divide that by 0.3. And actually, I therefore, in theory, could invest 66,000 into a venture capital trust this year. OK, and at 30% get back that £20,000 of income tax. Yeah, I can't get it back with a pension, or I could, but you know what, I'm limited the amount of relief, and I'm going to get the excess charge. So I can't do any more into a pension. What else can I do? That's where the key income tax benefit is going to come through for you guys here. So again, any income tax, but it's current year only. You can only do up to 200,000 in any 1 year into a VCT. But as we talked about, sort of typical amounts invested somewhere between sort of 15 and 25,000 pounds. Once you're in the VCT, of course, remember you've got shares in this big box, but you're exposed to lots of companies underneath it, within the VCT. Now, as those companies grow, because they are small when we start, and we'll talk about the limits of them in a minute, but as they grow, then those companies may well pay a dividend. Now, those companies will pay a dividend, of course, into the VCT. Now, that money's not in your hands, it's in the company that you own. But of course, the VCT can then pay that cash out to you as a dividend. And any dividends you receive out of a venture capital trust are tax-free. Okay. Also, of course, when we grow companies within a VCT, eventually somebody may well come and buy those VCTs, or the underlying company, or they might float. So our share, if you're like, your share in that company is turned into cash, lots of cash in the VCT, which again, we typically pay out to you guys as investors. And again, that's a tax-free dividend. We have to stay in the VCT for 5 years, guys, in order to keep that initial tax relief. Okay, so just be mindful of that. The money is in the VCT. It's you can get it out, but very few people do, because of course they lose the tax relief. So it negates the reason for doing it in the first place. But over the period, you hopefully will get some tax-free dividends. On very well-established VCTs, that can be typically around 5p a year. On others, it can fluctuate. Okay, any growth in a VCT is also is tax-free, is capital gains tax-free. Okay, so we get income tax on the way, tax relief on the way in, we get tax-free dividends, and we're tax-free on the way out. Okay, so we think about pensions and ISAs. Yeah, ISAs we get tax-free growth, pension we get tax relief on the way in. Here we actually get both. Now, I'm focusing on venture capital trusts. That Graham's slides mentioned another vehicle called an enterprise investment scheme. I'm not going to dwell too much on it, guys, but I think it's worth mentioning in case it affects some of you. An investment by virtue of an enterprise investment scheme is actually it's exactly the same similar sort of companies as a VCT, which we'll look at in a minute. Okay, you don't invest in a VCT, you actually invest directly in the companies. But investing in an EIS can potentially give you 3 tax reliefs. Number one is the income tax relief we're talking about, and that can be current year. We could actually carry the relief back to last year. If 1 or 2 of you might have sold assets triggering capital gains, really in the last 2 years, technically it's 3, but realistically in the last 2 years, then by investing in companies qualifying under the EIS scheme, again, we can defer the capital gains. So there's some capital gains tax relief. Also, once you're invested in these smaller companies within EIS, after 2 years, and if you hold them on death, they are IHT free. But now I'm going to rein this back. To me, for EIS, I only be thinking EIS if either you've sold an asset, be it shares, or you've triggered that capital gain, or you want a blend of income tax and IHT relief. Really, the focus today, looking at people who hit the lifetime allowance, is probably people I suspect in their 40s, 50s, maybe early 60s. Okay. And IHT, I'm sure for some of you will be an issue, but let's assume you're not terribly fussed about it right now, and you haven't sold an asset, so capital gains isn't relevant. If it's just income tax you're looking for and an alternative to a pension, then in my world, certainly a VCT is where you'd start because of the income tax relief, the tax-free dividend, so a bit of liquidity along the way. And after 5 years, you can actually come out of a VCT. So you actually ask us, listen, I'd like to come out. We will get you out at whatever the value is. And of course, what you do that? Well, you could go into a different VCT or even the same one and get another slug of 30% tax relief. Okay. So there's an ability to really recycle VCTs and get tax relief almost every year, certainly when you come out. So hopefully that gives you a really good idea as to how the tax works with a VCT. Very, very, very straightforward, I hope. Now, you might be thinking, well, Andrew, this is all very well. Tax reliefs are great, and I get that bit, but what am I actually investing in? Which is a very good question. Now, this is just one VCT that we happen to run. Of course, there are a number of VCTs on the market for people from people other than PUMA, of course. But I thought useful to sort of look at the underlying investments here. We have a VCT called Alpha VCT. It's actually quite a new VCT. We started this in 1920. And this has grown now. It has 7 companies within it, and we raise money each year to grow that. We will probably grow that to around 30 companies. Okay, PUMA have been doing VCTs actually since 2005, guys. So hopefully that gives you a very good idea of the length of time we've been investing in VCTs and obviously getting people's money out at the end of it as well. The 4 points on the left-hand side are the key bits for me. I talked about smaller companies. Now, there's plenty of people who do VCTs and EIS and investing in startups. Okay, they all qualify for VCTs and EIS. Of course they do. That's why the government brought the rules into for you to help companies grow. But it actually also applies to companies with gross assets of up to £15 million, employees of up to 250, and so long as you invest in the first 7 years of the trading life of the company. So we can still invest in companies which have gross assets of £10 million, have 100 employees, and are 5 years old. Now that feels, yes, they're smaller companies, and of course there's risk, but that doesn't feel quite as risky as investing in a broad startup. We would certainly see probably companies, if they're going to fail, probably in the first 2 years. So we want companies to sort of got over that initial startup phase. So we are really investing in businesses that we do the due diligence. The owners and shareholders of those companies have grown them to a certain level, and now they've got a very difficult emotional decision for them to make. Is, in order to grow my company to a next level, I need some more money. Okay, and that's when they come to the likes of PUMA. All right, but we help them scale up, not start up. So the average turnover of companies, certainly within Alpha, is £5 million. So hopefully give you a bit of an idea there. And whatever the company does, makes, sells, produces, there's clearly a growing market for it. Its revenues are growing nicely. They may well be profitable when we first invest. If they're not, then we certainly envisage them being profitable within the next 6 to 12 months. All right, so we're scaling companies up. So from the FCA's perspective, as Graham will reiterate significantly here, is everything I talk about is high risk from the FCA's perspective. Okay, you're investing in small companies, but there are ways and means within my world to mitigate that. The first one within a VCT is say, right, let's invest in well-established businesses. The point about proven businesses, I've kind of talked about that, but a lot of these businesses need some technology. So there is an element of tech in this, but maybe introducing some technology into a very well-established existing business where that technology will help them grow. As you'll see in a minute, we'll talk about 3 companies. We've been doing VCTs for a while. Diversification is an interesting point, and this gives you a bit of a flavour of the VCT market. There are very well-established venture capital trusts out there with many more companies than Alpha has. Okay, and of course they are diverse. We would say, well, you need to look at what COVID has done to some of those VCTs. The other point as well is as you grow and you perhaps sell out of a position within a VCT, then of course that might create quite a lot of cash, which we can pay out as a dividend, tax-free dividend, as we mentioned earlier on. When you're a huge VCT and you've got to spread those proceeds across thousands of investors, it probably doesn't make a huge difference to the actual dividend. When you are spreading it over perhaps a fewer number of investors, like Alpha would be, then actually that will generate sort of somewhere between 20-30p as a one-off dividend to you as hard cash return, which is obviously very attractive. Okay, so huge VCTs have their place. Smaller ones also do for those sorts of reasons. We certainly feel, in terms of sector, generalist sector approach here that we do, plus having a number of companies in it now is helping us help attracting investors here. Okay, minimum investment there on a VCT is £5,000. So literally, if you've suffered or will suffer £1,500 of income tax this year, you could do a VCT. Okay, a little bit of a track record and third-party reports there, but I'm going to move on. This is the more interesting bit. There's actually 3 companies that we've invested in and are actually within Alpha VCT. So here's a business called My Kind of Future, or MKF, as we refer it to. If you think about a big clunky HR department in a company and how they sort of can operate and recruit people, or if some of you are old enough to remember something called the milk round. I remember leaving school or university and going to talk to large companies and sort of going to sort of open days that they might do to have a look at brochures and think about whether you want to join them. MKF is if you like, an HR tech platform. It works with 2 groups of people. Firstly, the companies that want to recruit people, and on the left-hand side, you will see 4 companies that it already works with. There are lots more others, but including BT, Deloitte, Cisco, Burberry. So large companies, you'll all have heard of them. MKF effectively makes sure those companies get their literature right, get their internship right, position themselves in the right way, get all of the sort of social media stuff right to attract the talent that they want. MKF also works very closely with the potential recruits to make sure they've got the qualifications, approaching in the right way, the CV looks right, their internship program hopefully might take them into a full-time job with that company. So it's guiding them through that company, if you like. So MKF, as you can see, is hopefully what I've just described, very much scalable worldwide. There's no geographical limits to this. You could also see this applying to, we're all sat at home working now. Some of us cope better at home than others, but migrating people back into the workplace, people on maternity leave coming out, managing working at home, and then work back into the workplace. So MKF has done very well since we started and growing, and you can see the sort of investment we made in that last year. Another business, much more established one, this one's called Lecole. All Lecole do is make high-performance cycling gear for the amateur rider. Okay, has done very, very well, is very profitable now. A lot of this sales, as you can imagine, are made online. They sponsor a number of cycling teams, and you would certainly see them if you're into your cycling or watch the tour, various Italian and French tours. A little bit of point about Lecole, which I think is interesting when you look at smaller company investing in, is, well, you follow the money. We invested some money into Lecole for branding and marketing, 2.35 million in 2018. And what you typically do is when you invest in smaller companies, you give them targets to hit. And if they hit those targets, they're probably going to need more money again to take them to the next level. So we put more money in there this time last year. And that company is growing very, very well within VCT, within Alpha VCT. That you could ultimately benefit from. Remember, within the VCT, you're benefiting from all of these companies, not just 1 or 2. Here's a much newer investment we did at Christmas, Cameramatics. This essentially is a sort of vehicle safety technology provider. Essentially, they put cameras in trucks for fleet operators, essentially to mitigate, sort of reduce risk and improve safety of the trucks and also the people in them, drivers. So they triple-digit growth last year, 2020, in terms of the financial performance of the company, and more importantly, of course, a significant reduction in accident claims from fleet operators who are using those products, the Cameramatic products. Okay, so that's where we're in. Significant due diligence, guys, goes into the underlying investments here to help make them grow. When you come into something like Alpha or other VCT, similar Alpha, you put £1 in, we're targeting £1.50 to £2 return over that 5-year period, okay, plus your tax relief. So really you're going from 70p, okay, pound less your 30p is 70p of real cost to sort of £1.50 to £2. Now that return is going to be a blend of dividends along the way and the underlying growth. And after 5 or 5.5 years, you might say, I'd like to come out because you want the money or you want to reinvest in other VCTs. You might just stay in there because actually your income tax profile fits that. You're just enjoying the tax-free dividends. Okay, so coming back to what we talked about, remember, this is high risk from the FCA's perspective, but if we scale up, not startups, proven businesses, good diversification across generalist sectors. The last way to reduce risk is when we invest in a company, we hope, of course, it will grow. But what if it doesn't? Say we invest in a business worth £5 million, we've put £1 million in, and after 3 years, there's an exit at £2 million. So clearly its value has fallen from 5 to 2. Well, our £1 million, so potentially your investment, comes out first. You're in a first return position on that. Okay. The fees, take those with a pinch of salt, quite frankly. Those initial fees are what you might get charged in March. Lots of people do this sort of tax planning really late in the tax year. Most people, I think, should really start to think about it now, really, as the year goes on, because the initial fees will reduce. You'll have much more of a bigger choice around VCTs. But if we come back to that slide around the tax relief and trying to link this back into what Graham was saying as to, you know, when you're in pension drawdown, you're suffering income tax, we could mop it up with a VCT. What alternatives do we have to putting more money into in pension? Clearly, we could use a VCT, and hopefully that works. What it doesn't do is important. It doesn't mitigate the sort of charge because some of the charge that you do get for oversubscribing into a pension is not taxed. This actually only mitigates income tax, okay, not necessarily a charge or like a penalty for overfunding a pension, but there's very much an alternative. Now, one point I didn't go through because I think the slide started slightly in the wrong place is maybe a little bit about PUMA, so forgive me going back. Last bit, it'll give you a bit of a size. Some of you probably thought PUMA made trainers and tracksuits before you came on this, but we've been around for quite some time. We're part of a much bigger group called Shore Capital, which was started in 1985. Sizable assets under management. Now, PUMA is about 150 people UK wide, as you can see, and there are 3 bits that we do. Today we've focused on that growth funding bit, giving you an alternative to a pension, but with an investment growth into smaller companies with the tax reliefs. Property finance and quoted equities are purely for inheritance tax, guys, so probably not the audience today, giving you IHT relief after 2 years. As long as you hold it on death. So alternatives, you feel like, to gifts and trusts, but I'm not going to dwell on that now. Okay, and that's actually back at the start. But that's really it from me, unless there are questions, of course.
Thank you, Andrew. Okay, are there any questions? I appreciate that's quite a technical topic from both Graham and Andrew there, and quite a lot to take in. It's quite difficult to kind of breeze over it and just give you a bit of a snapshot. But if there are any questions, we can take them now. Okay. No, it looks like you went through everything in the detail needed, Andrew and Graham. So that's good. So just to close off there is just to really say we're still planning on running client webinars every month. So the next one we've got is on Friday 11th of June about opening up the global economy. Following that, we'll have another one just introducing our client portal and how to get the most out of that. So there'll be information going out to everybody about the next webinars. But if we don't have any further questions, I'd just like to thank Andrew for joining us today.
Thank you.
And thank you, Graham.
No problem.
Thanks, everybody.
Great stuff.
Thank you very
Thanks,
much.
Vicky.
Bye now.
Thank you.
Bye.